All right, let's go ahead and get started. Good morning and welcome everyone for the first Tuesday Market Outlook webinar for 2024. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be sharing with you my thoughts and analysis on the broader market. But first and foremost, I hope you all had a great Christmas and New Year period. Hopefully you guys got to have a little bit of a break, and yeah, I'm very excited for 2024, especially from a markets perspective. So let's go ahead and dig in. But before we do, just our usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, we'll be starting off with the major equity indices. We want to highlight those key levels. We have seen a pullback across the board, which is something that I have been waiting for quite some time. I'm sure many of you would agree with me that equities just seemed a little bit overextended heading into that Christmas period. And even though the broader sentiment was definitely bullish, we the risk reward didn't favor the upside at that time, especially for shorter term ideas. Whereas now that we've had a pullback, it does provide some interesting opportunities. But from there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model as well. We'll take a look at a couple of subsectors of interest, and we'll end today's webinar with some bullish and bearish market observations. Only 3 ideas for today, a couple of them from last year, just having a look at how they have performed over the Christmas period. So starting off with the S&P 500, looking at the SPY ETF. So we are very, very shy of all-time high territory at that 480 area. And yesterday's price action was incredibly bullish. I mean, I was expecting a bit of a steeper pullback here for the S&P, potentially back to 460, which would have given a much better risk to reward. But throughout the year, especially if we continue with the bullish tone that we are seeing, and there's a lot of signs that may continue. The reason I say that is because of interest rates. We are in an interest rate declining environment. We could get an interest rate cut as early as March, with 2 additional cuts expected for 2024. And we could expect a market very similar to late 2020, early 2021, which was a very strong bull market, and with limited pullbacks. I mean, when I look back to that period, the one thing I would personally regret was not entering more bullish positions when we saw similar pullbacks like this one that we've just experienced in the last few days, where you may be waiting for a much deeper pullback. And, learning from my mistakes, as you all should, these limited pullbacks in a bullish tone may not last for that long, and in my opinion, you should be a bit more aggressive with entering those bullish trades, even when you start to see a limited pullback, and not necessarily wait for the perfect pullback. For example, like this perfect pullback to 460, it didn't quite happen. So that's why, be a bit more aggressive, in my opinion, with entering the bullish signals for 2024, and use these limited pullbacks as those entry opportunities. So yeah, we have had some very bullish price action yesterday. Price set to open a little bit lower this morning. In terms of key levels, again, 480 is really the one that we're looking at. Sentiment and structure remains bullish. The 2 major impacts from a macro perspective this week are going to be CPI data coming out on Thursday. Lower than expected inflation will give a green light for the Fed to definitely cut in March. So that's going to be a big tailwind for equities. But higher than expected inflation would throw a spanner in the works, and we could see maybe a bit more of a decline or a lot more volatility. The other thing that we have to be looking at is earnings season. Earnings season unofficially starts this Friday with the major banks as usual. So we have a few of the big banks that are going to be reporting earnings, going to be setting the tone for the rest of the earnings season. And analysts are expecting an 11% increase for earnings in 2024 compared to a 3% increase in 2023. So from a fundamental perspective, we are heading into 2024 quite strong, and also from a technical perspective. The other theme that we have to look at is a soft landing. can we avoid a recession with despite having elevated interest rates? So far, it's looking like we potentially could. When you look at the jobs data, we had jobs data coming out on Friday, added more jobs to the economy than expected, but we saw a very limited move in equities in markets in general, and that does indicate to me that the shift, there's going to be a shift now from what investors are looking at. Before, we were looking for a low jobs number because that indicated the labor inflation would be declining because the labor market was such a key contributor to inflation. Now we are looking for, in line with expectations or slightly above expectations, because that does indicate a good economy and therefore would indicate a soft landing and an avoiding of a recession. So that is why we must, for 2024, start to make that shift and look at non-farm payrolls and jobs numbers in a more traditional sense. So the Nasdaq 100, the tech-heavy QQQ ETF, it did actually reach all-time high territory a couple of weeks ago, immediately pulled back, but again, we have some strong bullish price action here. Technology could very well be at the forefront of this market rally, given the fact that interest rates are declining. But one thing that I do want to point out is this negative divergence, and I'm sure many of you have already seen this, where the longer-term momentum indicators are actually declining when price is rallying. And that is traditionally a very bearish signal from a technical perspective. But if we have the macro side of the formula, act accordingly, as in we get lower than expected inflation numbers and steady jobs numbers, along with a dovish Fed that are going to be cutting interest rates 3 times this year, we could very well see this negative divergence be invalidated like we did in 2022, early 2021, and we could see a continuation higher here for the major indices and equities across the board. So for the Nasdaq 100, again, didn't pull back as much as I expected, just shy of that previous swing level, but has now bounced higher. And you do want to be looking at gaining that upside exposure and looking for continuation in this rally. IWM, so we're looking at small caps here with the Russell 2000 ETF. IWM broke above the 200 level, major level of resistance on the weekly time frame, but fell just short of the 210.23.6 fib level, and it did pull back quite a bit, all the way down to 192. We saw that outperformance disappear relative to large caps, and there was underperformance as we saw yields move higher as well during this time, but it does look like there's a bit of a bounce back here. Yes, price is set to open a little bit lower this morning, but small cap outperformance usually signals the start of an early bull market. So I do still think that that this pullback that we experienced isn't too much of a bearish signal. I do think there is still potential in this rally because overall price structure remains bullish. There is still a lot of underlying momentum, and small caps have outperformed for a few weeks now compared to large caps, and we can't ignore that. The next key level, if we do get a continuation of this decline, is 188 at a 38.2 fib level. But if we see a bounce up here, you're looking at, again, this previous swing level at around 205 and of course 210, which is a 23.6 fib level as well. TLT, the Treasury Bond ETF, we did see yields move up higher in the last few days, like I said, and during that time, price rebounded lower from that $100 major resistance zone. We see price sitting at around 96, set to open a little bit lower this morning, and there's some further support at around 94. Now, the thesis for TLT, like last year, was looking into selling into the rallies. This year, we are going to be actually doing the opposite and looking to buy into these retracements lower. And currently, TLT is experiencing that. We are in an interest rate declining environment, therefore bonds will continue to move higher, yields will continue to move lower, and therefore bonds, and that will have a positive impact on bonds due to the inverse correlation. So the next key levels, should TLT move higher from here, or should it retrace lower to 94 before bouncing higher, is of course the $100 level. But after that, you're back into this range between 100 and 108. So we'll see what happens when we get there. But for now, I am looking to potentially buy into these declines. The US dollar has seen a bit of bullish price action after yields moved higher. Now, in the last couple of days, we are seeing a lot of consolidation. It does look like investors are waiting for the inflation numbers and, of course, the start of the earnings season. And from there, we should get a better direction as to where price could potentially head. What I found quite interesting was a strong intraday rejection of 103. And it hasn't quite reversed all the way lower just yet, but you can see price is struggling to reach that level once again. So my bias is leaning to the bearish side from a technical perspective. And from a macro perspective, lower interest rates will potentially see the dollar continue to decline. You also have to consider the dollar, the DXY's value here, or the US dollar index, is made up from its performance relative to other major currencies like the yen, the pound, and the euro. And those central banks are not in a position to decrease or cut interest rates just yet. And therefore, we're going to see some short-term underperformance for the US dollar. Bank of England may be looking to cut interest rates soon, but definitely not the Eurozone. So yeah, US dollar, I do expect to see it's continue to be under some pressure. But once it reaches 100, and we may see some consolidation at that level, maybe a slight breakdown below that. Again, it's very much macro focused, and it's very much dependent on what other central banks start to do. Okay, moving on to gold. And with a weaker dollar, gold has found some momentum. It reached at 192 level, pulled back, and then during the Christmas period managed to climb its way back up towards 192, 193, major resistance zone here. You can see that it's a multi-year resistance zone from 2020. And price is still staying at these elevated levels, even draw an uptrend there, but not really able to break above 192. I expect to see maybe some more consolidation, and very difficult name to trade right now, in my opinion. You could be looking to sell call credit spreads, which are bearish. Should price rally towards 192, the risk reward does favor the downside. But if the dollar continues to weaken, we could very well see a breakout above that 192, 193 area. Now, oil has been quite tricky in the last few weeks. We've seen overall a bearish trend, but price did reach its support zone that we were looking at 70. The next support zone was 66. It hasn't quite reached there, but the structure remains bearish with lower highs and lower lows, as you can see here. And we're seeing a lot of consolidation in recent days. So very tricky in terms of getting an actual trade out here. But the way I'm looking at oil is through energy companies. So energy companies tend to have a high exposure to oil prices. And during a time where equities across the board are rallying, we're seeing oil decline and energy companies therefore underperforming relative to the broader market. So therefore, I am going to still keep my neutral to slightly bearish bias here for oil. But the one thing I did notice was this momentum is starting to improve. And you could argue that's positive divergence. So we could potentially see a rebound from this between 66 and 70, that support zone. We could potentially start to see a rebound from there, or at least some consolidation, which is kind of what we are already getting now. So sector rotation, we're looking at a daily sector rotation here. 9 sectors in the improving and leading categories, 2 in the lagging and weakening. So energy in the weakening category, as you can see, losing out on relative momentum against the broader market, and relative strength indicating just how bad oil prices are relative to the broader market. That is why the sector is underperforming. We also have in the weakening sector communications. It was in the leading category for a while, and it is now rotating towards that lagging category. But I wouldn't say there's alarm bells ringing for this the communication sector just yet. Again, things can change very quickly. Also, we have healthcare, utilities and staples, our 3 defensive sectors, all in and around the same area between lagging and improving. We have seen a strong rotation into these defensive sectors during the Christmas period when the major indices were consolidating and experiencing a slight pullback. Investors were rotating towards these defensive sectors. But depending on how the CPI inflation numbers come out on Thursday, if it's lower than expected, we could start to see strong outward rotation from these sectors into the likes of technology, communications, and even discretionary. So we have a few names in the improving category, including discretionary, industrials, materials. And in the leading category, we have real estate, financials, and technology, still providing some leadership, but especially for financials, we're going to have to wait and see how these earnings figures come out. If it comes out better than expected, expect financials to continue to move into this leading category. However, worse than expected could very well see rotation back into this weakening category very quickly. So moving on to some of the subsectors of interest that I have, we have KRE, the regional banking ETF. I'm looking at this name because we do have earnings coming up, especially for the major banks. And while KRE is a regional banking ETF, there is still a strong correlation. Now, a lot of underlying momentum, as you can see, 50-period CCI touching those overbought conditions has since come to more modest levels, and the 6-period CCI reached an oversold condition and started moving higher. So this indicates a good buying opportunity heading into earnings, and I am looking for a potential breakout above 54 and a continuation towards that $60 level. So this is maybe a bit more of a riskier trade, given that it is an earnings, it's a longer term earnings play, really. But the fact that price has respected 54 resistance, not exactly reverse lower, it's rather retracing lower, looking for another leg higher. I do think it still provides a good risk to reward bullish opportunity here. Now the JETS airline ETF, a name that we've been looking at for quite some time, ever since price made that double bottom at the $15 level. Price breaking above that $17 level, rallying all the way to 19.40, pulling back and is now back at those levels once again. This is a longer term play for those of you that are new, for those of you that have been there for the last few market outlooks, I've been looking at JETS and I've always said that this is a name where you may want to buy the shares outright and look for a longer term holding. Airlines were severely impacted due to COVID, and by 2024 is where we originally started to say that traffic would be returning back to normal, if not better. So I do think price is a little bit discounted for where it should be, and therefore we could expect to see a continuation high here for this ETF. Oracle, new trade idea for today. So Oracle had an earnings announcement a few weeks ago, big gap down from 115 all the way down to around the $100 level, finding some support. And yesterday had some bullish price action. I'm looking for a gap fill and a continuation back towards 115. It did experience a pullback followed by a bit of bullish price action here. So the risk reward does favor the upside, and the fundamentals are quite strong. Oracle is, you could consider it a legacy technology name, and for that reason, I think it's one of the more safer bets within the technology space, especially after this pullback. And when you look at the technology names in general, a lot of them are trading near all-time high territory, or a little bit, maybe not all-time high territory, but a little bit overextended. Whereas for Oracle, we have had a gap down, and that provides a nice risk to reward to the upside. Lowe's, looking at the home builder ETF, looking at the home builder name, and I do like home builders as a subsector in general. Right now, we've seen a lot of bullish price action. Lowe's has moved higher with a lot of momentum, breaking above a couple of key levels, especially the 210 area. It's pulled back quite nicely, and exactly at 210 found some bullish price action and is starting to move higher. So the risk to reward favors the upside, targeting that 230 to 240 area here. And not just Lowe's, you can look at other home builders names as well. It's very similar chart where it had a very strong bullish run followed by a pullback, and it provides a very good bullish opportunity. And finally, we have Zoom. This was an idea from last year where we were bearish when prices at around 72. Initially did pop up a little bit higher, but this is a major resistance zone on the weekly time frame between 74 and 75. I expected to give it some slack because I knew that there was a bit more in this resistance zone that price could rally into. But since then, we've had some very good bearish price action here. So in my opinion, I think now is a good time to at least take partial profits on Zoom and potentially take full profits should price decline all the way down to 65. But yeah, and if you are a bit more conservative, feel free to take full profits right now. Zoom, ah, it's one of those names where it's going to be underperforming its overall sector. And we are seeing that underperformance, especially with price unable to break above the 75, 76 resistance zone. All right, and with that, that is all I have for you today. Thank you so much for joining me, and I will see you tomorrow for an educational webinar on how to trade earnings season. And if not, then I will see you next week, Tuesday, for another market outlook. I hope you all have a great trading week, and yeah, see you either tomorrow or next week, everyone.